Okay, welcome back. I hope you enjoyed your lunch. So now we'll have the first panel of this CEBRA conference. My name is Asger Grønlund, and I'm currently working as an advisor at the Danish Central Bank. So the topic of this panel will be the global financial system and the role of the US dollar. And this is, of course, a question that's always interesting for central bankers and academics, but given the changing geopolitical landscape, perhaps more relevant than ever. So I have three very insightful panelists with me here on stage. They will each deliver a presentation on the topic, and at the end we'll have 30 minutes left for discussion and questions. And I very much encourage the audience to ask questions. So our first speaker is Friederike Niepmann. She's an assistant director at International Finance Division at the Fed Board. And Friederike has done research on international banking and finance, and she'll give us a US perspective on this topic. Our second speaker is Signe Krogstrup. She is one of three governors here at Danmarks Nationalbank, and she has previously done research within international finance. And Signe will offer us a European policy perspective on this topic. And our third and final speaker is Philippe Bacchetta. He's a professor of economics at University of Lausanne, and he has done a lot of research on international macroeconomics. And Philippe will offer us an academic perspective. So I think we should just move to the first presentation. So Friederike, please, the floor is yours.
Okay. First of all, thank you very much for inviting me to this panel. It's a great pleasure and honor to contribute here. Before I say anything more, I will remind you of the usual disclaimers. So whatever I'm saying today are my views and not necessarily the views of anybody else associated with the Federal Reserve System. I also want to thank my colleague Bastian von Beschwitz, who provided some of the material for today's presentation. More generally, I'm drawing on research that has been done in the International Finance Division. So I was tasked with reflecting on the future role of the US dollar from a US perspective, so I'll try and do my duty here. I'll start with discussing a bit the dimensions of dollar dominance and the benefits and costs. Then I'll look at how the dollar's role has changed in the past 10 years, and then specifically over the past year. I'll provide some arguments why the dollar's role or important role may continue, and with some food for thought from some recent research. So I think, as everybody knows, the dollar is the dominant currency in the world and has been so for the past 80 years. This chart is actually well known. I think different people show different versions of it. Dollar dominance has these different dimensions that we can measure, and they reinforce each other. On the left, you see the dollars and other currencies rolled in FX transactions. The dollar is in blue and the euro is in orange. Here, the dollar can reach 100% because you always have two sides of an FX transaction, and you see at 90% practically all transactions involve the dollar on one side. Then the second is FX. I actually have to probably pull my own slides because I have a hard time seeing my slides here. Excuse me. So the second dimension are FX reserves. So most of FX reserves in the world are held in US dollars, more than around 60%. Similarly, in international banking, when banks engage in cross-border banking, most of those transactions are denominated in dollars. When firms issue debt in a currency outside of their own debt, or even governments, then that currency is typically also the US dollar, and then we have also the dollar dominant in international payments as measured by activity in SWIFT. And as you know, often international trade transactions are denominated in dollars, so even countries that are trading with each other where no party is the US will choose to denominate and transact in dollars. So the first four components here actually go into the currency usage index that my colleagues in my division, among others Bastian von Beschwitz, have computed. The SWIFT, the information on international payments and export invoicing is not part of the index, mainly because it's hard to get continuous and recent data on this. I'll come back to the index in a second. So what are the benefits and costs to the US of being the provider of the dominant currency? So I think the most prominent one that's often discussed is that the US pays lower interest when it borrows, and this is typically measured in terms of the convenience yield, so the foregone return that investors are willing to, the return that investors are willing to forego because they hold a US asset and not an asset in another currency. Then, of course, when more transactions are done in dollars, US firms and to some degree even households face lower exchange rate risk and lower hedging costs. The US, because the dollar is used worldwide and any dollar transaction somehow touches the US financial system, has a large reach when imposing sanctions and can enforce sanctions. Because the dollar circulates and we have more cash in circulation and so on, the seigniorage income is higher. And then, of course, since dollar demand tends to create a strong dollar, imports become cheaper, but on the flip side, exports become more expensive, and so may reduce the competitiveness of US firms in exporting. And then, of course, we know that the dollar appreciates in crisis, so these dynamics are particularly true in crisis episodes. So these are just a few of the benefits and costs. Of course, and Asger already alluded to it, we wouldn't be here talking about this topic if there weren't big changes happening in the world that could have an effect on the role of the dollar and other currencies. And we all know what I'm talking about, but actually, it's nice to put it in pictures and measure it. So on the top right, I'm showing the geopolitical risk index that my colleagues Dario Caldara and Matteo Iacoviello have developed. And you can see that since the invasion of Ukraine by Russia, geopolitical risk has been elevated. And actually, if you look at domestic conflict, unfortunately, also conflict is on the rise. Then, of course, we have seen trade policy and tariffs used now much more than before as a geo-economic tool. On the bottom right, I'm showing you the trade policy uncertainty index that the same authors have developed. Again, with the while we've seen global tariff rates come down over decades, now we have an increase in tariffs again, and associated with this a lot of trade policy uncertainty, especially since the US announced reciprocal tariffs in April 2025. And this is maybe a development that has been going on for longer, maybe over the past decade. The use of sanctions has increased, and in particular the use of financial sanctions. You can see that in blue here, and this is of course the US to a large degree imposing financial sanctions. Okay, so how has the dollar's role changed in the past 10 years? Here on this chart, I'm plotting the index of international currency usage that I already mentioned over the past 25 years. On the left, you can see the dollar is dominant, followed by the euro, and then you have the British pound and yen. And when you look at the left picture, you think, okay, not that much has changed, but when you zoom in on the right, then you can see that over the past 10 years, the dollar's role has declined somewhat. Now, on this chart, I'm just decomposing the changes. On the left, you see how this index has changed for different currencies over the past 10 years, and on the right, you see the different underlying factors driving these changes. And you can see that, the dollar has lost, the euro and the renminbi have gained, and then also other currencies, this would be the won or Brazilian real, have increased. And again, I think this is a reflection of the increased use of financial sanctions, where countries are rethinking whether they need to become more independent of the global financial systems that heavily, or the dollar system if you want, but also efforts, or maybe reconnected efforts by China to internationalize the renminbi. So now I'm going to go quickly through these three dimensions on the right, where the dollar has lost its its role to some degree. I'll start with official reserves. Probably many of you have seen this before. So since 2015, we see a diversification of official reserves into other currencies. The currency shares have actually, for the major currencies, have actually been relatively stable, as you can see. But the share of other currencies, again, the won, the real, and other currencies have increased. And you also see, the renminbi appearing here in orange. So also more FX reserves are held in Chinese renminbi, but the overall percentage remains quite small. Then going to dollar debt issuance, again, here also since, I would say, 2020, we've seen a decline in the issuance of dollar debt relative to other currencies. On the right, I think this is pretty telling. I'm showing you a chart from a paper by my colleague Judith Temesbury and BIS co-authors that introduces a new database containing international debt security statistics. And what you can see here is that basically, in the paper it's called dollar waves, right? So you can see, they argue there's a waxing and waning of dollar debt issuance, and you can see that when the dollar gains, the euro loses and other way around. So we know that the firms, opportunistically issue debt depending on funding conditions, and you can actually see that the dollar seems to be on the rise again. And of course, as monetary policy changes in the euro area and the US, we may see these shares and total amounts of debt issued change again. Finally, thinking about global banking, again here, since the euro crisis, the euro area or the euro's use in cross-border banking has increased again. You can see that on the left with the orange bars rising some. But also, I wanted to highlight this work by my colleague Laurie DeMarco and Joshua Walker, who've written this nice FEDS note that shows how, sort of, as a result of the Chinese authorities' push to internationalize the renminbi, Chinese banks are using the dollar less in their cross-border banking. So the red line is actually non-Chinese banks' dollar share in cross-border lending, and then you see the dashed line. This is the Chinese banks using the dollar in cross-border lending. That has gone down while the other line has stayed flat. So just another dimension of where where we see more more use of the renminbi instead of the dollar. Okay, so now let's talk about the past year, which was quite eventful. As also, I think we all know, the dollar is a safe haven currency and tends to appreciate in crisis. And here I'm showing you how the dollar has moved in weeks where the S&P 500 fell significantly and also the VIX rose. So on the left, this is for the past 25 years, and you can see that on average, the dollar tended to appreciate in these crisis weeks, although there were periods where the dollar depreciated, especially around 2001, 2, 3. And then on the right, I'm showing you the same thing, but just for the past year. So you can see that in the first half of last year, the dollar depreciated during these crisis weeks, depreciated on announcement of additional German defense spending, depreciated on the reciprocal tariff announcement in April, and then we had a downgrade of the US also. But actually since then, the dollar has behaved normally again, or typical with the past 25 years, especially also since the conflict in the Middle East broke out. So overall, the dollar seems to continue to be a safe haven currency. Sorry. Okay, then let's look at demand for US assets. It continues to be strong. On the left, I'm showing you net purchases of US financial assets, broken down by type of assets, and you can see that not that much has changed over the past year and a half. we see strong inflows into US equities in 2025, and you can see that the net purchases of treasuries actually has also remained relatively flat. On the right, I'm showing you some evidence for diversification by fund managers. So this is showing, this is using EPFR data on investment funds, and it's taking investment funds that invest in at least 2 countries and then looks at the share of assets allocated to dollar-denominated assets. Or no, this is actually the US. And you can see that this share has come down since 2025. Some, I would say, after rising continuously. And, there are different reasons for this. We know that the US is very tech-heavy at the moment. This may be an argument for diversification. But also in 2025, actually, while the US stock market performed very strongly, actually the rest of the world outperformed the US. And so, of course, if you have funds flowing from the US to other countries, you would see an increase in the stock market in the value. But there are fundamental reasons why this has been happening, because also other countries are benefiting from the AI boom. So overall, the demand for US assets continues to be quite strong. So I'm going to provide now some thoughts on why we may see the dollar's role continue as it is or not change fundamentally. I'm going to skip this slide on European safe assets because I think Signe will talk about it. So moving to China, as I already mentioned, the Chinese authorities want to promote the use of the renminbi internationally, but this is ultimately hindered by capital controls and a weak rule of law in the country. And on the left, I'm showing you the assets held by foreigners, Chinese assets held by foreigners onshore. You can see that, asset holdings increased quite a bit, but have actually declined or stalled since around 2022. Of course, the Chinese economy isn't doing so well, so this may play a role here. But overall, we have foreign holdings of Chinese assets at $1.5 trillion, but that's dwarfed by, foreign holdings of US assets of 25 trillion. So, it's even though more foreigners are buying Chinese assets, the total quantity is still relatively small compared to the US. And then on the right, I'm showing you the usage of the Chinese payment system, CEBRA. So it was created in 2015, and since then, the volume of transactions in that system has increased. But when you see over the past few years, it has actually stayed relatively constant. So there was this rise in usage after the Ukraine-Russia war broke out, but now over the past few years, not that much has changed. So you cannot give this presentation without talking about digital assets, so I'm also going to nod to this here. So, of course, we see a lot of innovation in that space, be it through cryptocurrencies or central bank digital currencies. And of course, to the extent that these new currencies or assets are used to settle international payments, they could be, a new form, and they could decrease the importance of the dollar internationally. But at the same time, of course, we have US dollar stablecoins. They are probably the most advanced, if you want, digital asset out there. And now we have the Genius Act in the US regulating US stablecoins. So, of course, there is this potential of more dollarization, in particular in EMEs, as stablecoins become, US dollar stablecoins become more used more. And so on the left, you see the market capitalization of US dollar stablecoins. You have Tether and Circle in blue and, in brown and blue. You see how much that has risen. Then on the right, you see the growth in usage of stablecoins in different regions of the world. I realized that is a little bit small. The first bar is Latin America. The second is Sub-Saharan Africa. And then comes Eastern Asia. So in particular, in emerging markets where people are looking for a store of value, this is where stablecoins have grown and are projected to grow pretty strongly. And since stablecoins are ultimately backed by short-term US assets and treasury, including short-term treasuries, the increased use of stablecoins could actually promote the role of the dollar internationally. So I'm going to conclude with two aspects that should be some food for thought. So here I'm showing you a chart from a paper by researchers at the Bank of England, including Marco Garofalo, and they looked at how cross-border bank lending to Russia by UK banks changed and how the denomination of that lending changed. And you can see that before the invasion of Crimea, you actually had a lot of lending in dollars, and then within 2 years it switched and the euro became the dominant currency in that type of lending. There's a lot going on, and this is a very specific example, but I think it shows that geopolitics can change the way that currencies are used, and in fact, you know, historically, switches in the dominant currency followed major geopolitical events, and yeah, it just shows that switching can happen relatively quickly here in the course of 2 years. So then there's this question whether even small changes in the dollar's role matter at all. Is it consequential? You know, we can't see how the dollar's role is going to be diminished a lot, but do small changes matter? And I think, you know, one should carefully think about it. So a paper by Jesse Schrager, Matteo Maggiori, and Christopher Clayton makes the point that the US has a lot of geoeconomic power over the global financial system, close to a monopoly. You can see that on the right in terms of the blue curve here. And so their argument is that when you are at a point, and that's more on the left, if you are at a point where you have a lot of, the dollar is very prominent and you basically have a monopoly, right, then small changes or decreases in the dollar's role can actually have larger effects because the benefits of this geoeconomic power sort of increase the more of a monopoly you have. And I think there are other reasons why small changes may matter, if you could think about network effects and so on. And then, of course, you know, we have the convenience yield that applies to a huge amount of US borrowing, and even small changes in the convenience yield will apply to this big base. So I know that some estimates of the cost savings from convenience yields are 120 billion. So I leave you with that number here. So thank you very much, and I look forward to the discussion.
Thank you very much, Friederike. Very interesting to hear your perspective from a US side. So Signe, you're up next.
Well, thank you so much for inviting me. And I also want to welcome everybody here because this is my hometown, and I'm really happy that Danmarks Nationalbank is taking part of organizing this conference, and particularly at such a nice time, such a beautiful weather, so you can see Copenhagen from the right side. So welcome to Copenhagen, but that's not why I am here. We are at this conference discussing really important topics, and there's a lot going on in the global financial system, and it's so important now that we collaborate, that we exchange information, that we have conferences like this. And one of these topics is international currencies. What's the future of international currency? So this panel, I've been looking forward to participating in this panel. I will say a few remarks from a European perspective, and that is, of course, I don't have to put myself or take another hat on. Denmark, we have our own currency, the Danish krone, but it is pegged to the euro. It has been pegged to the euro since the beginning of the euro, and even before that, we were pegged vis-à-vis the Deutschmark. So we have had a fixed exchange rate system and closely linked to the euro area and to Europe for 40 plus years. And so we think of ourselves as very closely integrated. So when I talk about the future role of currencies, it's not because I see the Danish krone as having a global role in the future, but the euro is, of course, very important to us in this respect. So I'll say a few words about the US dollar role, why we see that as an increasing risk, and Friederike touched on many of the issues that I will touch on. Why diversification could be a mitigant for some of these risks. And of course, my focus on the euro, what is holding the euro back as a global currency, but what are also some signs that it could move forward. And then I'll finish up with some links to the current EU policy agenda. So first on US dominance. So the US dollar is, of course, the global currency. I don't have to show you that. Friederike made a very good, gave a very good overview of that. But that means that it's also dominant and very important in European financial markets. That exposes European financial markets to certain risks. For instance, we have large US dollar denominated portfolios, we have reliance on US dollar funding, FX markets, markets in general in Europe. And that it produces financial stability risks that need to be managed. And some of these risks, we have lived through these risks for many decades, and they have been very manageable, but some of these risks are increasing. And Friederike mentioned some of them related to geopolitical risks going up. But I would say also just looking at financial stability risks in the global financial system is something that we need to monitor really closely. And I will mention two. First one being that the very key role played by US treasuries in the global dollar system and the rising US debt and increasing concerns that the rise in the US debt is not going to be sustainable. So that is something that is a key concern. Another key concern is that we have rising balance sheets in the global financial system, very much on the non-bank financial sector side. So non-bank financial firms' balance sheets are increasing. A lot of that is dollar denominated. There are signs of increasing leverage here as well. And we have very low transparency in those markets. We also don't see exposures. We are not completely sure of interconnections. So those are also issues that we need to monitor closely and that could bode risks for the future, related also to the dollar status. One mitigant for us would be diversification of global currencies. And here I have a picture that's similar to what you saw before, so I don't have to go into the categories, but when you look across categories of the roles of a dominant or a global currency, you will see that the US dollar has a very strong role. Some of them have maybe declined slightly in recent years or in recent decades. Some of them have also become stronger. And the general picture is that the US dollar has a very strong role. What we would like to see with a diversification perspective is other currencies, and from the European perspective, particularly the euro, taking a more strong role in this global system. What you see here is that if you look at the far right side, you see that the US economy, of course, is also the biggest economy still in the world, but the European economy is really a close second, comparable to China. So the role of the euro is, relative to economic size, is not as strong as the dollar. And if you look at trade, the role of trade in the global economy, the European area, Europe would far surpass the US. So still, we don't have a role of the euro that is commensurate with the size or the importance of Europe in the global economy. Now, why is that? There are good reasons for that, of course, and we have heard some of them. I think the main reason, and you will all be very aware of this, is that when we talk about means of exchange and global currencies, network effects are really important. So we have network effects and self-reinforcing network effects of the global currency. And that is the network effect between trade invoicing, means of payment, liquidity to back up claims in the future. All these things, when everybody else is asking for that denominated in US dollars, of course you will yourself want to do that in US dollars. So there is a question, and there is a big debate out there as to whether we are going to have a more diversified global currency system, or whether we will at some point see a shift from the dollar to another currency, or whether this is a reason why we will not shift out of the dollar anytime soon. Then there are some reasons that are specific, and I have here on the slide, specific to European capital markets. An important one is the very important role of the global safe asset, the US Treasury market. We don't in Europe have a safe European safe asset that is commensurate in size, that is commensurate in safety and in liquidity. Then we have, besides that, also a lack of deep and integrated capital markets. And so that goes very broadly in Europe. And a good example of that is if you want to go to the stock market in Europe, you will find 27 stock markets, actually even more. So European capital markets are fragmented. And then we have, maybe not directly propping up the US dollar, but I think it's a really important aspect that we always need to keep in mind. And that is that the investments that are US dollar denominated, because they originate from investments in Europe, in the US, they are usually seen as having superior returns. So that goes back to the productivity challenge that we have in Europe. The need to get more investments that are propping up productivity and therefore will build better returns in the future. That also plays a role. And I have a few slides here, some examples. So 2 slides on this, the problem of safe assets. I see that there are 2 problems in Europe in having a European safe assets, and they are related to size, and they're related to fragmentation in the market. And size is maybe the least of the concerns, but you still have it here. You can see the red line here is developments in the US, outstanding US treasuries and % of GDP outstanding in the market. And the blue and brown parts is European government debt. And this is divided into the part which is considered safe, so AA plus rated or above, that's the brown part. And the rest is all the other safe or not sovereign debt, not necessarily safe, sovereign debt. So there's a clear size difference. Even if we had pulled it all together in Europe, there is a difference in size. And this actually, the size difference is actually bigger, but because here it's in % of GDP. And GDP in the US is just bigger than GDP in Europe. So the size difference is even bigger than what you see here. What is more important is that we're lacking a unified product, a single liquid big market for a euro-denominated safe assets. And this slide is an illustration of that point. We have many different issuers, 27 issuers in Europe. They're not all on this slide, but many of them. Many of them are too small. There's too little liquidity, and those are the ones that are to the left of the y-axis here. To the below the x-axis. Sorry, I'm mixing it up. So below the x-axis, you have issuers that are small, and then therefore that they lack liquidity, but particularly also size for the individual issuances. And then you have the ones that are to the left here. They're the ones that are considered not necessarily safe. So you have large issuers, France, Spain, Italy, that are big, that are liquid, but that are not necessarily safe in the sense that their returns will not necessarily be going up or stable in times of global concerns. So don't have safe haven features. So what remains as safe assets here is the Bund market, German government bonds, as you see in the upper right quadrant. And then you have EU issuances. They are almost on the verge of also being eligible. Of course, EU issuances are not big enough, so they suffer from two problems. They are not sovereign debt, they are supranational debt. That should be solvable, but it's also not a market that is big enough in size. And even if there was a consideration to go there currently, it would take many years to build up a large market of European supranational debt. So, very fragmented market, but also a lot of potential, a lot of issuance in this market that could be acted on. And maybe we can get back to that in the Q&A. Another example here is the point that I wanted to make about European investments. So in Europe, we have a high savings rate, and we are saving more than we are investing ourselves. And a lot of those investments are going into US investments, particularly when you look at the Danish perspective. We have very high balance sheets, we have very high savings, we save a lot more than we invest, and we invest a lot of that abroad. And we have moved in our pension sector to be able to take more risk. And a lot of those investments, they go into the stock market, they go into the Danish stock market, foreign stock market, but a lot of it over the past decade, and especially the last 5 years, have gone into the US stock market. And that's what you see here. That's the difference between 2018 and 2026. So currently, these are the balance sheets of aggregate of our pension funds. And they have grown a lot in size, but the main categories that have grown are the stock market. So those are the US stock market is the gray below. It has grown a lot. And then the red one, which is EU stock markets, has also grown. A chunk of that is home bias and Danish equity that have been bought into that. So even in the past year, we have seen an increase in the holdings of our pension funds in this market. We have seen less flows, and perhaps to make a bridge to what Friederike showed us, less flows, but strong increases in the value of these positions, and hence less flows. And allowing positions to grow just with valuation is also a deliberate choice by these pension funds. So when all these savings, they move into productivity-enhancing investments in the US, of course, that is also part of this self-reinforcing dynamics. It increases the demand for US dollars, it increases exposures in the US, but also over time, it props up productivity in the US. So there's a lot of self-reinforcing mechanisms at play. There are also some recent developments that support a stronger role for the euro. And here, let me refer to the yearly report that the ECB makes on the international role of the euro. So they're pointing to stronger issuance of international debt in euros. It increased last year by about 30%. So that is the highest that I've seen in a long time, but a lot of that was corporate debt, and a lot of it was actually US tech firms that were issuing debt denominated in euro. So of course, as was also said before, that shows that there has been a demand in the investor community for that type of debt. And then we've seen signs of switching safe haven behavior. What we also saw in slides before. And I'll get back to that in a slide in a second. What we've also seen is that, or hear about, is that there has been an increase in demand for bonds in euro, and especially safe bonds, government bonds, to the extent that we've seen an increase in the convenience yields of European safe bonds. And that is also a sign that there has been a switch of demand. It's hard to find good data that will show that on an aggregate scale, but we do see that in the pricing. On the safe haven behavior of the euro, just an overall slide. So this goes lot less into detail than what we saw before. But what you see here is that the Swiss franc and the yen, they correlate. This is a daily correlations of between a safe haven factor, so concerns in markets, notably the VIX, and the currency itself. And you see that when concerns go up, the value of the Swiss franc and the yen, that goes up. And usually that has also been the case for the dollar. Those are the gray bars are those correlations from 2007 and until April last year. So those were positive correlations. That's what we call safe haven correlations. Since April last year, those correlations have turned around for the US dollar and for the euro. So previously, the euro did not have any types of correlations. Since April last year, we have a positive correlation. And the US dollar now has a negative correlation. But these are very simple overall correlations. And once you dive into the specific shocks that we saw during this period, you can have more nuanced conclusions, as what Friederike just showed us. Let me just mention that what we see is that when you divide it into funding shocks and safe haven shocks, those two are two different things. So when you have US dollar funding strains, you will tend to see these correlations coming back for the US dollar, but we had very little of that in last year. So the jury is still out. We had too short of a period to make conclusions here, but there are definitely some shifts in behavior. Last thing on cross-border payments. Here, the jury is very much still out, and there's so much going on. So let me just very briefly say a few words. In Europe, there's a lot of work on cross-border infrastructure for payments within Europe. It is moving very fast, and a lot of this is based on fast payment systems and account-to-account payments. And there's also a lot of cross-border work going on there. Plus, there is a development in the wholesale infrastructure for tokenized financial payments that is being worked on. In the US, stable coins is much more the approach also from the authorities. That is an approach that can also be developed, and we already see, as what we saw before, that that is moving fast in some countries. It could also prop up the value of US treasuries and therefore the strength of the US dollar. There are still some remaining issues around the stability of stable coins. And then we have a lot of developments outside of Europe and the US. China, we just heard about CIPS, but there's also Enbridge, a lot of work on cross-border payments that take different approaches. So here there are three different approaches. Very interesting to see what the future payment system will look like. Let me conclude with this slide and say that there are some encouraging signs for a stronger role for the euro, but the signs are not pointing in a direction that will should make us expect that this will happen anytime soon. So I think that we very much have to expect that the role of the dollar will remain. But there is a lot of work in Europe on a policy agenda to support productivity, growth and resilience that will also help to prop up the euro when we take a longer time horizon, look at a longer time horizon. So completing the savings and investment union and strengthening the single market will all feed into higher productivity growth, higher returns, sources of stronger demand for euro in the future. There's a lot of work on cross-border payments infrastructure. I just mentioned some of those. And then there is a desire and a lot of discussions around expanding the pool of safe assets. But this is quite controversial because it also becomes political, but a lot of work going into looking at that. And let me stop here.
Thanks a lot, Signe, for this insightful presentation on the European perspective. So now we have the final presentation. Philippe, please.
Okay, thanks a lot for inviting me to be part of this very nice panel. So one of the roles that the dollar takes is for the offshore dollar funding. And this is something that is very important as for the safety of the global financial system. Unfortunately, we don't have good data on that, so we only have a partial picture. An interesting report was issued recently by the BIS Committee on the Global Financial Stability System that gives an overview of what we know for the data that is available. A lot of the data is for global banks, but there are also there's also data for non-banks and for a broader context. So, for example, they present this a nice picture that shows the foreign currency exposure of banks, which mainly will be large banks. And you see in velvet the dollar and in blue the euro. For many countries, well, the one on the left is offshore centers, where the dollar is very large. But for many countries, you see that the position of dollar liabilities is very large. Not so for Denmark, where it's mostly blue, but it's for Canada, Switzerland, etc. So this shows a large liability exposure in dollars. They show many other interesting things in this report. One thing that I found interesting is the fact that the part of the foreign currency financing and dollar financing is done at the central, the holding company or the headquarter, and then is distributed through internal markets. So that's one of the interesting aspects that they report. They also show that there's a growing role for NDFIs. Now, these liabilities are large, and it turns out that in various cases, the assets are even larger, and there's a mismatch. Often, for example, for emerging markets, the mismatch goes the other way. You borrow a lot in dollars, and you're exposed. Well, here you have a case where you have many of the banks, in particular, that have a mismatch where the assets in dollars are larger than the liabilities. So what you can do, and what banks typically do, is to hedge this mismatch using FX swaps. And this was easy to do before the global financial crisis because of the cost of dollar through FX swaps of synthetic dollars was about the same as direct dollar borrowing. But since 2008, you have now a wedge, which is the cross-currency basis or the CIP deviation. That's actually how I got into these issues, is starting from the CIP deviation. So we have now a different situation where it is more costly to obtain dollars because of CIP deviations. So here on the left, before the global financial crisis, you could say that dollar markets were globally integrated because CIP arbitrage kept the synthetic dollar funding cost close to direct dollar funding. So the FX swaps was just a funding operation. But after the global financial crisis, you can talk about onshore and offshore markets that may have different prices because of limited arbitrage due to the CIP deviation, which is persistent and time varying. So the synthetic dollar rate is just the US dollar rate plus the CIP deviation. So the CIP deviation is related to this need for dollar funding. And in normal times, this is not a big issue because you may just have to pay a small basis, but it is relatively small. But what matters is when you have tensions in the offshore dollar funding. Since now you have a separation, a segmentation between onshore and offshore, what is interesting is to think about what could happen to funding in offshore, to shortage in offshore dollar funding. And this is an issue I've spent some time on. So the basic idea is what could we have shocks to this offshore dollar funding, and we had these type of shocks during the global financial crisis, during the COVID shock in March 2020. So these shocks can occur. In that case, you see very large increase in the CIP deviations and tensions in the offshore dollar market. And in the future, we may see some of these shocks again if you have shocks related to the dollar market problems with the, for example, US financial system. So, and an interesting question is, what are the implications of these dollar shortages? So we know what, how we can react, what kind of policies we should take. So the first, of course, the first impact is that they will increase the CIP deviation and the cost of dollar funding offshore. This will increase the risk of the rollover risk for FX swaps that typically have a short maturity. This could increase the financial health of global banks. There is an IMF, the Global Financial Stability Report mentioned this issue. They could increase the probability of default of large banks. And there may be various aspects, but two of them I spent time on with my co-authors, Scott Davis and Erik van Winkop. And I'd like to mention these two aspects. One is the impact on the dollar value, and the other are the implications for non-US global banks. So let me start. I'm not going to describe the two full papers, but I will just give you the basic result. So in the first of the two papers, we look at the implications of dollar shortages on the value of the dollar. And we have a very simple model with FX spot and swap markets, where both the exchange rate and the CIP deviations are endogenous. And then in this model, we look at the implication of dollar shortages, offshore dollar shortages, which is basically a reallocation of dollars from offshore to onshore. So these are shocks where there is no change in the demand for dollars. The demand for dollar is constant. It's just a shock that reallocate dollars across onshore and offshore. I'm going to give you two examples later on. But we find that this reallocation away from offshore dollars will lead to an appreciation of the dollar. That appreciation will not take place with without CIP deviations. And the basic idea is that if you have an offshore dollar funding shock, this increases the cost of the synthetic dollar, which is an increase in the CIP deviation. But then synthetic dollar borrowing becomes more expensive, and you're going to use more dollar spot. And by buying more dollar spot, you just have a dollar appreciation. So the intuition is very simple. But this means that in times of tensions, well, the dollar may appreciate for safe haven reason, but on top of that, this segmentation between onshore and offshore puts an additional pressure on the value of the dollar. When did we observe such episodes of onshore offshore? Like here I have two examples that we have in the paper. In 2016, there was a reform of the US money market where US money markets decided to invest much more in the US. They were just holding dollars, but they reallocated dollars outside of the US towards the US. And this at the same time came with an increase in the CIP deviation and an appreciation of the dollar. On the contrary, a reverse shock where swap lines were announced, this decrease. So the swap lines are just the reverse. You basically reallocate dollars from the US to the non-US, swap lines from the Federal Reserve. Then CIP deviations decline, the dollar depreciated. I'm going to get back to swap lines in a couple of minutes. The second paper is about the impact of non-US global banks. So the IMF worried about this, and we decided to investigate this issue, even though we have, partial data. So we try to construct the exposure, the dollar exposure of non-US global banks at the country level. And we saw that the total US claims increase over time. So on the left, you have the total US claims of non-US, non-Chinese global banks, so more than 15 trillion. The second graph is the amount of cross-border dollar lending in blue by non-US banks, in red by US banks. So non-US banks do much more cross-border dollar lending. And the right picture shows the share of wholesale liabilities in dollars. Wholesale liabilities that are less stable, we see that about half of their liabilities are in dollars. So using this data, we look at episodes where countries face a large decline in dollar liabilities. And we look at what happens around these episodes. So this is what we find. So there are many variables here, but the upper left is the dollar funding. So you see where there's a time zero, there is a decline in dollar funding. We identified 22 episodes. The average decline in dollar funding is about 16%. What happens when there is less dollar funding? Well, we see that just below the graph below on the left, there's a decline in US claims, less dollar lending, but the decline is about half the change in liabilities. And maybe the other half is financed mainly by FX swaps. And because of the increase in FX swaps, there's an increase in the CIP deviation. We have some impact on the non-US wholesale borrowing, and we see an increase in the expected default. So that's what we see in the data. What we do is to construct a model to try to match the data and see whether a shock to dollar funding to wholesale US funding for non-US banks, whether we can match that. And we find that indeed we have the response in the model that is consistent with the data. But this should be a shock to the direct dollar funding of banks, not a shock to the FX swap market. The shock to the FX swap market, we find very little impact, but the direct dollar funding has a large impact on balance sheets. However, when we look at the expected default frequency, which is the probability of default, this increase is relatively small, is quite small. There are only a few basis points. So what we conclude is that the type of shocks we have observed so far in the last, say, 2 decades are not large enough to be a problem for non-US global banks. That's basically the conclusion of our analysis. It could still be an issue for NBFI we don't have in the model. It could be an issue for the borrowers. Since the global banks have to cut on their dollar lending, this will affect borrowers in the US and elsewhere. It's a problem with high-frequency market freezing that is not in our model. What we have in our model is we have multiple equilibria with somewhat larger shock. We show we could have bank runs. So in that case, this could be a big issue. So if you have situations where this offshore dollar funding could be a problem, then we can think about dollar liquidity assistance. And this is where these swap lines I mentioned before could be important. And this is analyzed also by the CFGS report, or CGFS. So they show, they have a survey of central banks, and they show that the central banks provide dollars to their local, to their national banks. In some cases, they use their FX reserves to finance this liquidity assistance, but most of the time, they ask the US for assistance, either through swap lines or repo lines with the Fed. And these liquidity lines are the inverse of a negative offshore funding shock. So this will have a reverse effect. And there are many papers in the literature that examine the impact of these lines. The lower CIP deviations, they can support dollar lending by non-US banks. So even if the global banks are resilient to moderate shocks, these lines should be important to avoid self-fulfilling runs, high-frequency freezes of the FX swap market, and maybe for institutions outside of the banking sector. A recent episode that is also documented in the report is Credit Suisse in March 23 that in the end had to be purchased by UBS. But in this process, over a couple of weeks, there was a huge instability and there was a huge demand for dollar liquidity. And the only way they could get liquidity was through the Swiss National Bank, but that had to ask the Federal Reserve for a FEMA loan, so they could immediately provide these loans and avoid greater instability. Well, I have little time left. I thought about some various issues. I was trying to talk about offshore dollar funding as a kind of a unique phenomenon, but of course there is a lot of heterogeneity across countries, across banks over time that should be better understood, even though we have very limited data, especially at the bank level. There's the role of NBFI we don't understand in this context of dollar shortages. And then there are issues related to the Federal Reserve liquidity assistance. Could this lead to moral hazard? And could this be used for geopolitical reasons? Could the US cut these lines? I'm confident that actually some research is trying to show that the US is benefiting from this assistance because it can avoid disruption in dollar funding and in dollar liquidity. So the main takeaways is that the US dollar is a dominant global funding currency. There are large offshore dollar funding, and the dollar funding market worked better before the global financial crisis because synthetic dollars were easier to create. Then we show that with moderate shocks, we don't have huge fragility for non-US banks, but there could be other parts that could be more fragile, and the dollar liquidity assistance is part of the global dollar architecture. Thank you.